Welcome back. It's a green-looking screen across Asia. The SGX Nifty is telling us that we'll start perhaps 100 points higher on the index. Good time to get some more trading strategies in. We have VK Sharma joining in with the FNO bets for the day. Vinod, good morning. Good to have you on the show. So, what kind of trades come to your mind, considering the cues are very positive today?
Yes. Good morning, Surbi. Good morning, Lata and Anuj. Our sense is that the markets are going to open sharply higher, as all your analysts have said. And the fact that the Nifty has closed above the 10,550 level, which is the 61.8% retracement of the entire fall, we have now negated the bear market which you are in. And although Mr. Jhunjhunwala has said earlier that we are in a new bull market, now the technicals are also pointing towards that. My first pick is Bharti Airtel, something in which we saw positions being pruned down yesterday. So I'm buying the 600 call at 16.65 or whatever the price is. I'll have a stop loss at 12 and a target of around 25. That's my pick from the Nifty stocks. And there are a host of other stocks like Balkrishna Industries, where I'm buying the 1320 call at 47 odd rupees, stop loss at 40, target of 65. And Cummins, of course, where we have seen a built up in the series to the extent of 33%. I'm buying the 420 call at 17 odd rupees, stop loss at 14, target of around 25. And my last pick is the insurance, from the insurance segment. The whole segment is doing well, but I picked up Max Financial, where I'm buying the 560 call at 29, stop loss at 24, and target of around 40.
Okay, thanks a lot for that, Vinod. Have a good trading day. And we're pretty close to the market opening. Actually, Prakash, thank you very much for your patience. We're just coming to you. Nifty is opened with a bang, expectedly so, about 0.9 higher right away at the open. So SGX Nifty gave us a very good indication. iShares starting 10% higher. I think the stocks we should concentrate on are HDFC Bank, ICICI Bank, IndusInd, all of them opening about 2.25 to 2.5 higher. So that's what will work in favor of the Nifty Bank. Then let me just see if we can get any of the stocks in the NBFC space, anything on Edelweiss, India Bulls. Can we get any rates in these stocks as well? Edelweiss and India Bulls, those numbers were not all that impressive. Okay, there's Edelweiss going with a 5%. Okay, we'll have to wait and see. I don't think this is how the markets will turn out. This is a bit random. So let's go to Prakash in the meanwhile. Prakash, you already spoke about HDFC Bank, but will you extend the buy to the other banks, say IndusInd, for instance?
IndusInd has, of course, seen some very major run-up as well. That token investment by the promoter group and incrementally how we've seen it getting re-rated. So the market is in a mood to reward some of these banks who are looking at shoring up their balance sheets. And I wouldn't be surprised if this trend percolates all the way down even to the weaker banks, right up to the Yes Bank. So one good day you'll probably come across some sort of a distinct fundraise announcement there as well. And these things happen as a trend. So the leaders have set the ball rolling, and the other players will also follow suit. But to buy into banking, again, I am saying an HDFC Bank reaffirms that don't look elsewhere. I'm here available at decent valuations than ever before. And then you could continuously be rewarded. So the risk reward is not as favorable in an IndusInd or an RBL or one of those, but they could be good trades, short-term trades. But otherwise, from a long-term perspective, I would still stick to a HDFC and a Kotak within the private sector banking pack.
Okay, fair enough. By the way, India Bulls is actually down about 9% and Edelweiss is down 5%. Edelweiss, I think, has a 5% circuit. Prakash, the other space I want to discuss with you is the future group stocks. They had a big rally, all the buzz and rumors, of course, helped it. But is the run coming to an end, you think? Or is this sort of dip a buying opportunity?
Oh, not at all. I mean, I think the opportunity was to get out, irrespective of what levels you had gotten, because there's been so much of value erosion over the years in this. None of them have operationally delivered what was expected of them. And even the financial engineering part of the entire group, if you see the kind of costs that they've incurred in terms of restructuring themselves every now and then, has never created any kind of a value either on the P&L or on the balance sheet. So I think that this particular move has been a very good opportunity to exit. Now, whoever buys into it with this whole liabilities of and the kind of debt burden would have to look at it for different benefits and then not just financial benefits. So I think for a shareholder in one of these group companies, it's been a very good opportunity, and we've recommended exit for most people and help this use this cash to deploy in stronger sectors and stronger companies rather than stay put here.
Okay, Prakash, good morning. Bajaj Auto, the market's been kind and charitable, not really focused much on whatever's happening at Valuj so far, but lots of weekend reports. Could things change?
Good morning, Survi. Yes, so yeah, I think the market loves to talk about something going wrong with Bajaj Auto, because how outspoken Rajiv Bajaj has been. So they always, people who kind of want to see the contrarian outcomes happening. And here you have a business management which is very clearly been sticking to that same rationale and logic and line of thought. They've not deviated, and I don't see any reason why they would. I mean, yes, there have been unfortunate deaths, 3-4 workers out of this whole plant, but this plant is the soul of the business for the company. I mean, you can't be running that in normal conditions if this plant was to shut, and it would be a big setback. In fact, I just want to point out that even the likes of Eicher and all, which have run up so much, the channel checks actually tell you that there are lots of discounting happening, lots of incremental incentivization happening at dealerships. So it's not that things are very rosy. We've just seen a little bit of a catch up on the dips in April and May, and that's kind of reflected in June. Is this going to be sustainable is a question. And in that case, a Bajaj Auto with its fair share of exports also is something which is much better off and more insulated. So I would believe that Bajaj will see the long-term investors come in if there is a dip, but this won't kind of be treated as
Got it, Prakash. Thanks a lot for your time today, and thanks a lot for your patience. Well, that's the view from Prakash. The market is still up about 100 points. Udayan Mukherjee is now joining us. Udayan, good morning. 2020 has been a different kind of year, right? Liverpool are Premier League champions. The biggest gainer has been, Ruchi Soya and Alok Industries, Sensex, Ballarpur, Suzlon. I mean, your thoughts on the kind of moves that we are seeing now in the broader market first, before we talk about even the Nifty and the Bank Nifty.
Morning, Anuj. Yeah, the broader market move has been a bit surprising in a sense. It's all very easy to look back and on hindsight and then analyze what caused the rally. But I don't think if you ask most people sitting in the end of March or the beginning of April, anybody, I mean, I certainly could not have seen a 40% rally in the index and the kind of rally that we've seen in many of the small caps and mid caps. It's taken me by surprise. I'm still quite confused about where things might head from here, because around the end of March, the screen looked like a pure bear market screen to me. I mean, there's no two ways about it. And right now, I would be lying if I said that the screen does not look like a bull market screen. It's done everything right over the last few weeks. And if you had told me that I had not seen what happened in March and I was looking at the screen right now, I would say this is a bull market, and the market made a bottom a few weeks back. But hey, things change, and that's what this whole few months have been about, that suddenly the price action makes you think one way. So let's see where things head from here. But you're right in pointing out that over the last few days, the texture of the market has changed a bit, in that the questionable part of the market has started to rally. Maybe it's because of a different kind of participation which has come in. The high quality end of the market, which did so well last year when the market was not doing very well, that has started underperforming. All your high quality and expensive blue chips have not done very well. And the one important thing for me, Anuj, is also the fact that the Bank Nifty has started to sort of slacken a little bit over the last week or so. So I would be wary, because this is a very important zone for the market, this 10,500 to close to 11,000. And you're seeing these sporadic corrections which are getting bought into. So let's see how things resolve themselves. But internally, the texture has changed quite a bit. And some parts are a little worrying, as you pointed out.
Yes, so then worrying texture of the market, some of the stocks that have risen are worrying, but macros are even more worrying. Just today, Citi has put out a report saying that the GDP contraction will not be 3.5% as they originally estimated, but a contraction of 6% because the infection has lasted longer than they thought, and the lockdown as well longer than they thought. Anyway, this disjunct is now old story between markets and macros. How do these things end? You've seen some of these play out in the past. Where should you be wary? How should investors and traders approach it?
You're right, Lata. I think it's quite fashionable now to talk about how markets don't rely on economics. And there have been enough instances in the past of where the market has actually not just moved against, but fed on this kind of macro pessimism when they were climbing walls of worry. So I think there is some rationale to the fact that markets and economies don't move in tandem. I actually don't care so much about the GDP print because there is some truth to the argument that you hear from a lot of people that the market is increasingly becoming a home for 30 or 40 companies which are getting larger and bigger in the US, in India, everywhere else. And therefore, the rest of the market does not matter, or the rest of the economy does not matter so much. But I worry about the earnings, Lata, because, you can say that the markets and the GDP don't move in a single line, accepted. But markets and earnings don't move in a single line. That I find a little harder to digest. So to your question on where this ends, I actually have difficulty seeing 3 months out, forget about where this will end, because, look at what has happened. You had a 40% fall and then a 40% rally, and all of this within a 3-4 month kind of a time frame. This is highly unusual. In fact, even when the rally started in April, I thought this was a classic bear market rally because of the ferocity of it. But it just continued, and continues. Who knows where it takes us? So this is a very unusual time. I think even markets are winging it in a sense. First they panic. That 40% fall, and then the huge relief, figuring out that lockdowns won't happen. And, even the markets appear, because you see it in the volatility indices as well. Looking at the screen, it is telling you that it is bull market, yet the volatilities are still quite high, and intraday corrections are often 2-3%, which means that in a sense, the screen is also telling you that it doesn't know. Right now, it feels like a bull market, but hey, you get a 20% correction from here for some reason, and everything changes once again, and you start singing a different tune. So, at this kind of a time, there is a lot of confusion. I'm confused. And if somebody asked me what should one do, I would say you have to participate. You cannot just sit out and pontificate on when a market is up 40-50%. You participate, but stay close to the door because you don't know when the tune changes. So I think nimbleness will be key in this kind of a market, because who knows where things stand 3 months out from here.
Okay, I think so. We can't hear. Well, Udain, I take your point. But, the ones that are growing, these are the strongest stocks, as you pointed out, they actually benefit. For instance, I think there is a migration of deposits to HDFC Bank and inevitably to ICICI and SBI as well. So actually, when the economy is in pain, the strong benefit because they probably capture market share as well. But nevertheless, therefore, do you just stick with the strong? Like you say, if you have to escape when the music stops, you should be in the large, liquid, strong ones. But you keep on buying them at these pricey levels?
That's not what the market is doing, Lata. In fact, the market is doing the opposite. And that's the thing which I can't wrap my head around. I take your point that Asian Paints and HDFC Bank gain market share at times like this, and therefore you're buying more of them because they will get stronger and they will power the index higher from here on. Then why is the broader end of the market rallying? Are you telling me that India is a market where there are 200 companies which will gain their market share and grow at a time when the GDP and the economic growth is slack? You cannot make a case that the GDP growth of the underlying economic conditions are actually better now or will be in the next 6 months than they were in January and February. It's one thing to say companies have gone back to 75-80% of where they were. It's one thing to say companies have gone back to 20% plus above what they were in January and February, especially when things even out after the initial thrust of the rush buying. So But that is not, I mean, what the question which Anuj started off with asking, why is the broader market rallying? So I think right now you have something else. You are not in a market where the screen is telling you that it realizes that 20 companies will do well and those 20 companies should be bought regardless of what the GDP print is. The screen is actually telling you that this will be a broader market rally. This will be a proper bull market in which mid caps and small caps, which have underperformed for the last couple of years, last 1 month aside, they will come back into vogue once again because they've bottomed out and they will give you those multi-baggers as bull markets typically give you. So how does that square with what you just told me, that the larger and the largest will gain market share? So, the two don't sit together. What you're suggesting is a recipe for a very narrow market which lifts the index, but the broader market continues to underperform.